Ever since ChatGPT dropped, generative AI has just completely exploded. It feels like it's evolving faster than we can keep up with. But with this incredible, massive boom, there's this whisper, this nagging question that's just getting louder and louder every single day. And here it is. Are we in an AI bubble? Seriously, it feels like this is the question on everyone's mind right now, from Wall Street investors all the way to Silicon Valley insiders. And the answers? Well, they are all over the place. I mean, listen to this. When the CEO of OpenAI, the company literally at the heart of this entire revolution, casually admits that, yeah, we're probably in a bubble, you know this debate is for real. This isn't just some abstract speculation anymore. All right, so let's dig into the uh-oh side of things first. What's the case for a crash? Well, there's some pretty serious red flags popping up that feel eerily similar to the dot-com era. And we all know how that story of massive hype ended with a historic collapse. So check this out. It's kind of wild when you look at the numbers. OpenAI was recently valued at a staggering $86 billion. But its revenues? A tiny, tiny fraction of that. And get this, the company is losing billions of dollars a year. That's a huge gap between perception and what the balance sheet actually says. And the amount of money being thrown around, it's just astronomical. It's been reported that OpenAI has been talking about deals that could total up to $1.5 trillion just to build out its own chip infrastructure. Just let that number sink in for a second. Trillion. But hold on, because that's just one company. A recent estimate from McKinsey projects that the total cash needed for all AI data centers and infrastructure is going to hit nearly $7 trillion by 2030. And to really wrap your head around how enormous that is, $7 trillion is almost 20% of America's entire capital spending across all industries this year. We're talking about one single industry planning to spend that kind of money. It is absolutely unprecedented. So you might be wondering, how is all this being funded? Well, that brings us to this controversial practice some folks are calling circular financing, and it's a system that can basically create its own self-fueling hype machine. Okay, let me break it down for you. A huge player, let's say a chip maker like NVIDIA, invests a bunch of money in a hot new AI startup. Then that startup turns right around and uses that exact same investment money to buy chips from NVIDIA. So what happens? NVIDIA's revenue goes up, and the startup's valuation gets a nice little boost. See? It looks like real organic growth, but is it? And I love this metaphor because it just nails the whole concern. It's like a company selling picks and shovels during the gold rush, but they're secretly just giving money to the miners so the miners can afford to buy those tools in the first place. The whole ecosystem just props itself up. And all this insane spending begs a huge question. Is there going to be enough real customer demand to actually justify it? One estimate suggests AI companies need to be making $2 trillion in revenue by 2030 just to break even. But the current forecasts, they're sitting at less than half of that. That is a massive, massive potential shortfall. And oh, the red flags don't stop there. We're facing real-world physical limits, like our electricity grids not being able to handle the load. The AI hardware itself costs a fortune and becomes outdated ridiculously fast. And the market is so concentrated that just 10 firms make up 40% of the S&P 500. A stumble by just one or two of them could send shockwaves through the whole economy. Okay, so that sounds pretty scary, right? But hold on, that's only half the story. A lot of smart people are arguing that comparing today to the year 2000 is just a huge mistake. So let's look at why this time might actually be different. For one thing, valuations are high, for sure, but they're not nearly as stretched as they were back then. That basic measure of how expensive stocks are, the PE ratio, it peaked at 46 during the dot-com bubble. Today, it's closer to 30. And back then, more than a third of tech companies were losing money. Today, that number is about half that. And here's a huge difference from the year 2000, the financial health of the big players. Unlike that debt-fueled frenzy, today's tech giants are funding this boom with massive piles of cash and balance sheets that are like fortresses. They're literally generating 3 times the cash flow compared to their dot-com era counterparts. And what about those sketchy-sounding circular deals we talked about? Well, there's another way to look at them. For a company like NVIDIA, investing in the ecosystem is a pretty rational way to grow your future customer base. Plus, this kind of financing is just a small piece of their total cash flow. And a lot of these deals aren't just blank checks, they're tied to actual performance goals. Okay, so we've got strong arguments on both sides. A case for a crash and a case for this time it's different. So what gives? Well, maybe we're asking the wrong question. Maybe the real risk here is something else entirely. What a lot of smart people are starting to think is that the real danger isn't a total 2000s-style market apocalypse. Instead, it's a bubble of unsustainable hype, where the vast majority of today's AI companies simply won't make it. We are headed for a massive consolidation. Just look at the numbers. Right now, there are over 500 AI unicorns. These are private startups valued at over $1 billion. The market is huge, yes, but it's not nearly big enough to support all of them. A culling is pretty much inevitable. And if you look back at history, this pattern pops up again and again. Major tech revolutions, from railroads to the internet, they're often bad investments on average for the early guys. The real winnings tend to go to the companies that come in later, build a sustainable business, and navigate the chaos. This slide just says it all, doesn't it? Being the leader, the big dog, during the initial rollout is absolutely no guarantee of long-term success. If you don't believe me, just ask Netscape. They were the undisputed king of the early internet. And where are they now? And so that leaves us with a real multi-trillion-dollar question. It's not if a wave of consolidation and failure is coming, but when. And the most important question for investors, for founders, for all of us just watching this unfold is this: who is going to be the Netscape of the AI revolution?